All right, so recently I made a mock $1 million portfolio. So there's a couple things I wanted to go over today. Number one is a update, and number two, there's a couple positions that I changed, so I wanted to go over that. So let's get into the ones I changed first, and then I'll go over a kind of a year-end or year-end/year preview kind of thing. So the first one that I got rid of was Capital Power, and I replaced it with Fortinet. Now, why did I get rid of Capital Power? I mean, let's just go into Capital Power just so we can... But the main reason is... So the main reason is Capital Power is a utility. Now, the problem with utilities is that in high rate environments, they're not going to do as good because the main reason you're buying a utility is because of the dividend, right? You're typically not going to buy most utilities because of the actual, you're expecting a lot of share price return, right? Because they're going to have less volatility, at least usually, so you're buying it for the dividend. Now, again, a lot of people say, okay, you have a 6.5% dividend, why would you sell it? Now, the first thing I would say here is that I'm not necessarily bearish on this company, but with this portfolio, it's a 20 stock portfolio. So I want to own the 20 stocks that I am the most confident in. And honestly, in my personal, like actual real holdings, I have probably a 2 or 3% exposure to this company, and I don't plan on selling it. Like, I don't plan on selling it at all because I think the company will do okay in the future. But that's my whole point here is okay. Like, this 6.5% dividend, if I was being honest, I would probably expect them to return like 6.5% on average over the next 5-10 years. So I don't think this company is going to have crazy good returns. If we look at their dividend, again, their payout ratio is only 55%, right? So the dividend is very safe. But again, if you look at this company, they're still underperforming the S&P actually by quite a bit. Let's check the 5-year. The 5-year, they're actually almost exactly even. Let's check out the 3-year, just out of curiosity here. 3-year, they're actually almost exactly even as well. So again, I think that this is a company that probably will be almost exactly right on the market. You'll get your 7% return per year, whatever you want to call it, right? There's not going to be a lot of share price return here. The vast majority of the return you're going to get here is the dividend, right? So again, it's not that I'm bearish on this company necessarily. I just don't think it's one of the best 20 companies that I would want to own, right? So that's why I got rid of Capital Power. The next one is Kroger. Again, another similar thing here. Again, Kroger's a little bit different in that they're kind of a grocery retail chain. Again, they are almost exactly flat on the year. Now, again, the one thing I forgot to bring up about Capital Power is that I sold it for about an 11 or 12% loss, which again, obviously that sucks, but technically you got that 6% dividends. You actually return maybe 5-6%, but that kind of sucks, obviously. But again, I think that a lot of companies that you're buying primarily because of the dividend, they're going to struggle in a higher rate environment because if you can get a 5% return guaranteed on a T-bill, well, buying a company because it has a 5 or 6% dividend all of a sudden becomes less appealing than a lower rate environment, right? So Kroger, again, I think they're still solid. Again, I do have a very small position, probably like 0.5% in my personal portfolio, which again I don't plan to sell, but I'm definitely not super bullish on this company, right? I'm just kind of meh because I think that again they haven't done very well. I mean, they're basically flat on the year. I think I sold this company for like a 0.5% gain or something like that in the portfolio. So again, basically broke even. But again, that's not including the dividend. Honestly, the main reason you're buying this company again is because of the dividend. Again, you got a 2.5% yield, and they're growing that 15% per year. And again, the payout ratio is below 50%. So the dividend definitely is stable. Historically, this is a company that's beat the S&P, but recently, I don't think it has. Yeah, recently it has underperformed. So that's why I did sell off this position. Again, in real life, I think that this is still an okay company. Again, I just don't think it's a top 20 position that I would want to hold, right? So again, like I said, there's two companies that I bought to replace them. Number one is Fortinet, which again is a company I've talked a lot about before. Again, really like it. Again, they've come down a lot since their high of the year. They're up on the they're up on the year, but they're down a lot from their high, right? They're down about 30% roughly. So again, that's why I'm buying. I think that this company is definitely a good buy here. I think if you can get it in the 50s, I think that's a really good deal, at least in my opinion. Again, I will be buying. Definitely will be buying in real life and in the portfolio. I'm very happy with this position. So that is Fortinet. And again, the other one that I bought was Paycom Software. Again, another company that's corrected. It's actually down on the year quite a bit. So let's check and see how much it's down. At one point, it was down 50%, but to end the year, it's down about 32%. So again, this is a company that's still growing very, very nicely. It has good fundamentals. I don't think that there's anything significant wrong with this company. It probably was a little expensive, especially up around 300. It definitely was expensive. I mean, right now it has a price to free cash flow of 39, a PE of 35. So again, right now probably about fair value, maybe a hair below, but I mean its average price to free cash flow over the last 5 years is 111. So that's crazy expensive. But again, for a company that's growing insanely quickly, that has very good profitability, very good metrics, again, it should be trading at a premium. But again, 111, that's definitely way too expensive. So those are the two moves that I made. Again, interesting to see how that plays out. And again, I am actually up on both of them already because I did this, I think it was a little over a week ago. Again, so let's go over the gain and loss on the year, if it will load here. So again, year to date, so again, we started, I made this, I think it was in like April or May, so I didn't actually make this right at the start of the year, but anyway, we are up about 23% on the year, which I believe the S&P is up about 22, so we basically broke even, right? We basically broke even, but I mean, a lot of that's going to be due to Fortinet, Paycom especially, but I mean, if we look gain and loss, there's actually no position that I'm down on, like not one position, which is very good. If we look at the best performing ones, QLYS, that's actually the best performing, which I'm very, very happy with. That one's up 60%. Again, IIPR up 50%, Go Easy up 48, AGM up 35, EQB up 31, OLED up 29, Steel Dynamics up 27, ODFL 28, APH 21, Microchip Technology up 16, ATD 13.87. So again, I'm up on every single position. Obviously, I mean some of the worst performing ones. Vici Properties basically broke even, although that one does have a 5% dividend, so which they're growing nicely. So I'm not super concerned there. Paycom and Fortinet, obviously I just switched. So obviously there's not a lot of change there. EQIX only up 6%, but again, I think that one's got a lot of potential still. I'm not concerned there. CN up just under 8%. Again, that one's more of a slow grower. I'm not super concerned there. EXR, again, they went through a bit of a restructuring or acquisition there. They're up 8%, not super concerned there. Waste Management up 8%. Again, that one's, again, more of a stability play, a slow grower, not super concerned there. American Express, 12%. Honestly, this one I'm considering selling off. Not because, again, I think it's a bad company, because number one, I already have Visa in here, which I'm more confident in than American Express. But American Express is very well established. I mean, kind of like Visa. I mean, they've been around longer. And again, they're growing their dividend nice. Everything is good as far as American Express goes. But again, I already have exposure to Visa, so I'm thinking about switching it out for something, especially given I'm up 12% on it. And American Express did not perform very well this year up until very recently. So Visa, again, that's one I definitely will be keeping for the long run. Again, probably not a stock you'll be owning 50 years from now, but 10 years from now, almost for sure. 20 years from now, again. ATD, again, that's one that I will always have, almost certainly. Microchip Technology, again, that's another example of that. Again, those are ones that I will always keep. Again, very good fundamentals there, very good growth. APH, again, another one that I'm very happy with. ODFL, that's one I might consider selling off just because it's performed very well, and I think it's kind of a little bit overextended. But we will see. If it goes back up into like the mid 400s, maybe I will sell that one off. Steel Dynamics, again, another one that I think is a solid company that I think you should have some exposure to. OLED, and again, another one that I really, really like for the long term. Again, this is an example of a dividend growth stock that I think is very, very good. EQB, again, another example of that. AGM, another example of that. Go Easy, another example of that. IIPR has a much higher dividend. I don't think they're going to be able to grow it as much, but I still think they're very, very solid. And then QLYS, again, the best performing stock I had in here. Again, this is a company that I was super, super bullish on for all of last year, right? Super bullish on, and I'm happy that it performed so well in here. The one thing that does kind of bug me is that I didn't have as much. I'm maybe 1 or 2%, and honestly, I wanted to be a lot higher. I just never had a chance to buy because I had positions in other thing. I probably should have sold something else to buy some of this last year, but again, those are the lessons that you learn as an investor. So again, that is how I performed this year. Again, basically exactly in line with the S&P. But the one thing that I would point out here is, again, the dividend growth metrics in this portfolio are absolutely phenomenal, right? Absolutely phenomenal. Again, the dividend yield is only about 2%, but again, I got a lot of companies that are growing very, very nicely in here. I think this is a portfolio where you'll have a dividend yield that's 20% 30 years from now, right? So that's why I have a lot of these companies, and that's why I continue to look for those kind of companies. So anyway, if you liked the video, please hit that like and subscribe, and stay tuned for more. And again, if you have any comments, feel free to comment.